Bloomberg Audio Studios. Podcasts, radio, news.
This is the Bloomberg Daybreak Europe podcast, available every morning on Apple, Spotify or wherever you listen. It's Thursday, the 6th of June in London. I'm Caroline Hepker.
And I'm Stephen Carroll. Coming up today, the European Central Bank is all but certain to cut rates in the coming hours, but the path after that looks far less clear.
Nvidia's value tops $3 trillion as the AI giant's market cap surges past that of Apple.
Plus, sun, wind and abundant land have attracted serious European investment to Namibia. Whether the projects ever pay off is a different story. We have a special report.
Let's start with a roundup of our top stories.
The European Central Bank is poised to start lowering interest rates from record highs later today. Analysts polled by Bloomberg almost unanimously predict rates will be reduced by a quarter point to 3.75%. However, Hargreaves Lansdown's lead equity analyst, Sophie Lund-Yates, says there's now increasing caution about what the central bank does after today.
We've been saying this for some time, and I believe that there is a disconnect still between not necessarily the timing of the first cut, but the extent of cuts, I think, more broadly for Europe and the UK. I don't think necessarily are matching up with market expectations.
As Sophie Lund-Yates highlighted there, economists expect 3 rate cuts this year, but traders are now fully pricing in just 2. We'll bring you the decision live here on Bloomberg at 1:15pm London time, followed by ECB President Christine Lagarde's press conference 30 minutes later.
The US competition regulator is said to be investigating whether a deal that Microsoft struck with AI startup Inflection may have been structured to avoid regulatory scrutiny. The Wall Street Journal is reporting that the Federal Trade Commission is now seeking information about how the $650 million deal was negotiated. Separately, the New York Times says the regulators reached a deal that allows them to proceed with antitrust probes into the roles played by Microsoft, OpenAI and Nvidia in the artificial intelligence industry.
Well, that news comes as Nvidia's market value rose above $3 trillion for the first time. Shares in the AI chip giant have gained around 147% this year, making the firm more valuable than Apple. Steve Sosnick is chief strategist at Interactive Brokers.
As early as February 23, I did a count at how many times they used the word AI in their conference call. It was 82 times or something. But they leaned into it early. Once this AI became the investment theme, Nvidia became the stock to watch. But at this point right now, my thesis is it's Nvidia's market. We're all just trading in it.
Steve Sosnick says one of the most impressive things about the business is its ability to pivot to new and emerging trends. The latest surge in the company's value comes as the CEO Jensen Huang said the firm plans to upgrade its so-called AI accelerators every year.
Goldman Sachs is expecting a wall of money to pour into the stock market, setting up a continuing rally this summer. The bank's trading desk is projecting an influx of passive inflows in early July. A note from the firm's Global Markets Managing Director, Scott Rubner, says that markets will also see rising interest from retail investors, which should also benefit share prices. Goldman's calculations show roughly 9 basis points of new capital entering the market every July. This year, that would be $26 billion based on $29 trillion in passive assets available for investment.
UK landlord LondonMetric is set to join the FTSE 100. It's part of a move that will push online retailer Ocado and others out of Britain's blue chip gauge. Bloomberg's Tiwa Adebayo has the details.
LondonMetric's £4.2 billion market cap will propel the company into the UK's top index. According to FTSE Russell, the firm will join others including Darktrace and Vistry Group, who enter the benchmark in a reshuffle taking effect later this month. Their success will push stalwarts of the group down the ranks, including online grocer Ocado, who will end its 6-year run in the FTSE 100. LondonMetric recorded a 20% increase in profit and boosted its dividend before securing its promotion, whilst Vistry Group's ascent follows a 40% rise in its shares this year. Meanwhile, Ocado stock is down 52% year to date. In London, Tiwa Adebayo, Bloomberg Radio.
In the general election campaign, Reform UK has closed in on the Conservative Party in the polls. The right-wing party is within 2 percentage points of the Tories after Nigel Farage returned to lead it. Bloomberg's James Woolcock has more.
There's a new word being whispered in Conservative circles, crossover. It means the scenario, almost unthinkable even a few months ago, where a poll puts reform ahead of them. Nigel Farage is trying to make that scenario a reality.
The Conservatives have betrayed that trust. They've opened up the borders to mass immigration like we've never seen before.
Now, Conservative Party strategists will insist that the UK's first-past-the-post system means a lot of those polled won't actually vote for reform on election day. But with reform fielding candidates against the Tories in many seats for the first time, any lost votes are likely to give the Labour Party a serious edge. In London, James Woolcock, Bloomberg Radio.
Now, in a moment, we're going to discuss the European Central Bank rate decision with sticky inflation, unravelling bets on significant easing out of Europe. We'll also have, of course, all the coverage live when the decision comes and the press conference too. But first, I wanted to talk about this. Wealthy people in the UK are racing to shelter their money. This is all about the general election campaign. Bloomberg has spoken to dozens of high net worth individuals and advisors. Now, Stephen, maybe not everybody is going to sort of weep about the loss of the super wealthy from the UK, but I can tell you that other countries are competing for them. It's not just, let's say, Switzerland, Monaco, Dubai. It's also Italy and Greece in Europe who've rolled out programmes to lure the super wealthy. And it's a really interesting piece on the terminal. I don't want to kind of focus on sort of expectations around Labour, sort of stereotypes around Labour of wealthy people sort of fleeing because it's a more left-wing party. But this is based on the conversations that Bloomberg has had, and I think is really interesting.
Yeah, look, part of it's to do with getting rid of the non-dom status, well flagged by both parties now that that's going to make a change for people who are taking advantage of that particular tax situation. But there's also, I mean, there's very different views about how many people were expected to move out of the UK. You know, the one of the firms quoted in our piece, Henley and Partners, saying that it's 3,200 high net worth individuals left last year. That was the most in Europe, according to their numbers. Others put it as a couple of hundred that would leave if these loopholes were changed as well. So it's something that there's, you know, it's not an exact science to know what the cause and effect of these sorts of changes would mean.
Absolutely not. And there's been kind of big LSE research on that very point. But it's also the fact that Labour wants to add taxes on private equity professionals and private school fees. So that's the kind of difference that maybe is seen as tipping people into, you know, seriously thinking about what they do with their money and maybe even where they live. And
of course, this is ahead of us having the full manifestos in the parties as well, so there could be more to come on this front as well. Let's go back to our top story though. The European Central Bank poised to start lowering interest rates from a high of 4% at its meeting today. Let's bring in our senior ECB and economics reporter Jana Randau for more. Jana, good morning. So this rate cut today, clearly telegraphed by policymakers at the ECB. The question is, what signals will we get about what happens next?
Indeed, that is the crucial question that everybody is looking to be answered today. And if you expect any official guidance like the kind that we've seen over the past years, then I think you'll be disappointed. There won't be any official, this is what the ECB intends to do. Just because the economy is so volatile at the moment, things are bumpy, and we've seen that in the latest data. But that said, policymakers cannot help themselves and offer some sort of direction nonetheless. And we've seen a lot of that over the past days and weeks, actually, where officials have come out and said, well, with the situation the way it is and the data coming in the way it comes in, July maybe not so much an option. We're looking for September. And you can probably see that reflected in what the president will say as well. So I would fully expect her to repeat that the ECB will be data dependent, will look at all incoming information. If she, for example, refers to a new update of staff projections, those will be out in September. If she puts a lot of emphasis on wages and new data coming in for the second quarter, those will be available just before the September meeting. So there will be clues for them to give that point to a quarterly pace and them having their eye on September. But really, it'll depend on the data, and it'll require reading between the lines this afternoon.
Okay, Jana, very interesting. So speaking of the data, how much concern is there about sticky inflation in Europe?
I would say still a lot. And what we've seen is that the ECB. The ECB has been talking about this rate cut ever since the start of the year, and their conviction has hardened in a way. And what they did was they set up a number of indicators to say those will be available beforehand. We're watching it closely, and we believe those data will show that we are right in our timing. And unfortunately, that hasn't quite panned out. We waited a lot for wage information. And wage growth, as it turned out, picked up at the start of the year. The latest inflation figures haven't been so great. Services prices went higher. Core inflation ticked up. Headline inflation ticked up. So there is still a lot of uncertainty. The trend is down. And everybody agrees on that. But we've had the chief economist, Philip Lane, warning that the road to 2% will be bumpy. There will be setbacks. So for this year, at least, he said policy needs to be restrictive. That tells you a lot about their concern about inflation. So the job isn't yet done. They have the scope to ease that restriction that is in place. Just because inflation is no longer at 10%, we are, approaching 2%, but we're not at 2% yet. And for a policymaker, that's not good enough. So dialing back restriction, staying very focused. And I think what they urgently want to avoid is making a mistake, easing too early, having to go back and hike rates again. And that sense of caution that will drive them, and that will dictate where policy is headed. So I'd say a lot of concern about inflation, a very careful approach on interest rates, and not a whole lot of visibility for the people who try to read them.
Right, Jana Rando, a busy day for you ahead. This our senior ECB and economics reporter, Jana Rando, there joining us from Frankfurt.
OK, now to a longer term story. The strong sun and wind of the southwest African nation of Namibia has raised interest from Europe in a plan to realise a number of green hydrogen projects there. Bloomberg reporters have been lucky enough to travel there to find out what these ambitious plans actually look like. And joining us now is our Africa energy reporter, Paul Burkhardt. Paul, good morning and thanks for being with us. What exactly is green hydrogen, and why aren't we already using more of it if Namibia can provide it?
Yeah, good morning. Well, green hydrogen, it's a clean fuel that could be used to replace diesel, natural gas. It has huge applications for replacing shipping fuel. And the way that it's processed, it uses wind and solar power to split water into hydrogen and oxygen. So that's how it derives the hydrogen. But the technology is still being developed, so it needs to get a lot cheaper in order to become competitive with fossil fuels, and we're very far away from that. So there's a first mover type thing that's going on where they're looking to build projects and to produce the fuel, and Namibia happens to be like a great destination for that.
Okay, so talk us through why Namibia happens to be the place to be.
Well, there's a World Bank study that puts Namibia's solar radiation as the best in the world, and I can attest from our visits there that it is quite hot even in it's winter now in southern Africa, and so the seasonal profile of the solar radiation is quite consistent throughout the year, and it's very strong as compared to the sun and probably the solar potential in Europe, where in winter it really dips down quite a bit. The other thing about Namibia that's a key factor in realizing these projects is it has a stable government that also owns the land, that makes siting these projects much easier. So those are really big factors that have led a lot of companies to look to develop there.
OK. I mean, Namibia must be about 5,000 miles from London. Why is Europe interested in these projects? It's a long way.
Yeah, it is. It's quite a long way. But, because of the amount of land and how easy it is to, I guess, site these projects, the port of Rotterdam, port of Antwerp, they've both been involved in setting up export terminals there. So you convert the green hydrogen into ammonia, then you can ship it by vessel. And so Germany has also been involved. It's just one of these places where the conditions are really optimal, and Europe wouldn't say have the same amount of room lands at a premium to realize some of these projects. Doesn't have the same conditions. So that's one reason why we see quite a few officials coming down to visit these projects and speak with the government down here.
Paul, what do these developments mean for Namibia?
If it goes as planned, Namibia has a very small population. It could become the plan is to realize this hub for green hydrogen. That would have a significant effect on the economy. It could double the economy, by some estimates. There's high unemployment in Namibia, and they really have grand designs. They've worked with McKinsey around plans that, if it reached its full potential, it would be the hydrogen-powered trains and green metals processing and all this. But really need to start with realizing some of these projects for green hydrogen production first.
This is Bloomberg Daybreak Europe, your morning brief on the stories making news from London to Wall Street and beyond.
Look for us on your podcast feed every morning on Apple, Spotify and anywhere else you get your podcasts.
You can also listen live each morning on London DAB Radio, the Bloomberg Business app and Bloomberg.com.
Our flagship New York station is also available on your Amazon Alexa devices. Just say, Alexa, play Bloomberg 1130. I'm Caroline Hepker.
And I'm Stephen Carroll. Join us again tomorrow morning for all the news you need to start your day, right here on Bloomberg Daybreak Europe.